Okay, in Chapter 9, we're going to talk a little bit about investment management concepts and strategies. And since this obviously isn't an investments course, this may come a little herky-jerky, that it may seem that it's not really a smooth transition from topic to topic. I just want to basically get some fundamental concepts that are important for you to understand about investing and the questions you should ask about investment opportunities. Let's just kind of leave it at that, kind of go and move forward then. We need to talk a little bit about risk. One of the things that I found is, especially lately, some people are a little afraid of the stock market. So I say, I'm just going to put my money in this guaranteed investment. This guaranteed investment is going to get me 6% a year, and I'm happy with that. I don't want to take any risk per se. Well, if you put that investment in there at 6% for 20 years, at the end you're roughly going to have $33,000. But if you had split that up a little bit, let's say we put some money in gold, oil, futures, options, stocks, and $2,000 in mutual funds. And let's just say that the first four options here all went broke. They all received a negative 100% on the first four investments. But the second investment earned 16%. That $2,000 investment would actually grow to $48,038. So, assuming that this mutual fund thing, again, it's not a great assumption, but if we assume that it's going to be that way on average over time, that's fine. But if any one of these would have hit, then this would have been far greater than the 33,000. So again, the idea, the concept here is that sometimes you have to take risks. With risks, there's the chances that you'll lose, but if you diversify your holdings, don't put all your eggs in one basket, in other words, there are opportunities for you to potentially make some pretty decent gains over time if done in the right way. So fixed income security returns are essentially that. They are fixed. Consider investment in a corporate bond. As long as the corporate bond doesn't go, the company doesn't go broke, the corporate bond will pay the cash flows that it owes you. So that is a fixed income. But you can't expect to get anything more. Now that's not to say that while the cash flows are fairly certain, that's not to say that there is no risk. There are a variety of kinds of risk with bonds. Interest rate risk. When interest rates change, value changes. Without getting into any real great concepts and theories here, when risk goes up, people want to get paid. You get paid through the rate of return that you invest in. So when risk goes up, for you to get a higher rate of return, you would have to pay lower prices. Again, it's fixed income, so the income can't change. So if you're going to buy this thing, then you would be willing to pay a lower price so that you can get a higher return. Inflation, everybody understands inflation. Maturity risk talks about the length of time of the investment. I'm sure you're familiar with default risk. Liquidity risk talks about whether or not you can sell the security or not sell the security. And in the end, callability risk talks about the company's ability to refinance its debt. And all of these risks combined are associated with investing in corporate debt. We need to create a bond portfolio that will help us to reduce some of those risks. There are essentially three basic types of reduction strategies we can take. One is a ladder bond investment. The ladder bond investments essentially say you're not going to put all your eggs in one year. So if you had $100,000, maybe you would put $10,000 in bonds that mature starting in 1 year, and then every year after that. So when a bond matures, you take that money and you invest 1 more year out. You could invest in tax-exempt bonds, right? We could invest in municipal bonds or federal bonds, so we could reduce some of our tax burden. The challenge, though, is with tax-exempt bonds, since the benefit is no tax payments, I'm not going to earn as high a rate of return. I could possibly diversify with some international bonds, but of course that opens up the can of worms of currency risk and political risk. One of the things that always fits with respect to investing is to talk about something called dollar cost averaging, where whenever you're going to invest, you invest a fixed amount every time period that you invest. You don't look at prices, you just find the investment you want to make and you continue to invest over time. That's called dollar cost averaging. So, when would you want to buy bonds? Well, you want to buy bonds. You want to look at things like the yield of the bonds, right? What yield is there? What rate of return do I think I'll receive if I purchase these bonds? What's the bond rating? Every corporate bond, every government bond is rated by an independent company. You would like to have bond ratings that are relatively safe. So you want to concentrate on AAA, AA, and A-rated corporate bond. And of course, we want to pay attention to the differences between the current yield, the return you would get in the very first year of the investment, and also the yield to maturity if you hold that bond to its final maturity. So again, looking and thinking about buying bonds, that is one of our structures. That's one of the things we're looking for. Underlying this that you really can't see, though, is the cash flow component. Most people purchase bonds for cash flows. They don't necessarily care what happens to the bond itself as far as price. Why might you want to sell the bond? Well, if it is underperforming in any way, if the corporation is changing, is there any losses that I might need to take so that I don't incorporate further losses? And of course, I need to take into account some tax consequences. So there are a variety of reasons why you want to buy and sell bonds. I'm going to take a jump on my political stump for a second and say that really you shouldn't be buying stocks and bonds. You should be buying mutual funds. We're going to spend almost a whole chapter talking about mutual funds. It is a better way to invest in bonds. It diversifies. It allows us to invest in smaller increments, and it provides a way to kind of get around some of the risk questions. Here's a reference to the rating systems. Let me make it just a little bit bigger so we can see just a little bit more. And of course, you can see at the top here, we have this AAA rated is the highest quality. As an individual investor, you probably don't want to invest in anything, certainly anything below an A, but I would, quite frankly, concentrate on AAA and AA rated bonds are the kinds of bonds that I would be searching for. They are the bonds that are the least risky, which means they're also going to pay the lowest rate of return. Now let's switch and talk a little bit about stocks. Equity returns. I mean, how do you make money when you buy a stock? Of course, you buy a stock to see the stock price change, but you're also looking for the dividend payments. So the return that you receive is a combination of the capital gains, the increases in prices, and the dividend payments that are distributed by the corporation. One of the things is that you should hope is that equity would outpace inflation, so that the growth of your investment at least will beat the inflation rate in the economy. What about the risks? Well, we have some ways that we can actually measure risks that are relatively easy to find. There's a statistic called beta. It's published for most stocks. It's the market risk. So this is the risk you take when you put a stock into your stock portfolio. Alpha is a statistic that tells you, if the stock market made 0 as a rate of return, what rate of return would you earn on this investment, or should you earn on this investment? Again, it's an estimated return. And the way I kind of explain this is, if you think about you're running a race, right? You and I are going to run a 100-yard dash. And I have an alpha of 30, and you have an alpha of 0. So that means in this 100-yard dash, I'm going to start at the 30-yard line, and you're going to start at 0. And even though my running skills are not that good, I'm thinking that I'm probably still have a pretty good chance of beating you in this race. So you would like to find alphas that are positive. They give you a jump, if you will, in the return category. Standard deviation is the way we typically measure risk in the investments and the corporate finance world. And the bigger the number, the greater the risk there is. Now, one of the ratios that we can find that's an investment ratio, that quite frankly it's published fairly frequently in the investment journals and websites, etc., is something called the Sharpe ratio. And just quite simply, this is a risk-adjusted return. You would like the Sharpe ratio to be positive, and you would like it to be bigger rather than smaller. So again, you're looking at performance, we want to find positive Sharpe ratios greater than, certainly greater than 0, up around 1, 2. Again, we would like to see bigger numbers rather than smaller numbers. Additionally, there is a website called Morningstar.com, and under Morningstar.com, they provide risk-adjusted ratings, where they adjust overall the company, they also adjust its returns, and they also place a performance measurement on risk. And it's all based on 5 stars. So certainly you would like to find stocks or mutual funds that have at least 4 or 5 stars. That places them in the top 40% of all of the investments that are being analyzed. So it creates the idea of a better run type of an investment, if you will. Again, when do you buy stocks? When you understand, you think that they are fundamentally strong. Again, this requires a great deal of research. You want to obviously be able to sell it at a price lower than what its current value is. So we have to have a way of determining what its internal value, what is it worth to the investing public. And then only if the price is less than that would you want to buy it. When would you ultimately sell stocks? Again, there are a variety of theories of when you would want to sell them. Conceptually, you want to sell them when one of 3 things happens. Number 1 is that you feel that it's not going to increase in value anymore. It has reached its peak. So when it's at its highest, that's when you'd want to sell the stock. What if your goals changed? If there's some realization of a change in your investment goals, the investment horizon, then that might be the time to sell stocks. And again, just the change of condition. They could be economic conditions. They could be your financial conditions. They could be the company's conditions. But all of those things together are signals that it might be time to consider selling our stock. How can we limit risk? Again, many different ways. We can use the dollar cost averaging approach. We can talk about a constant ratio plan. A constant ratio plan means that you're always going to put the same percentages into the same kinds of investments. Variable installment plans. This is where we're going to add a little bit of strategy to our investments so that we could change the weights from time to time based on the performance of the stocks or the investments that are involved in that particular program. And then finally, we could incorporate the options market. And what I would like to say about the options market is, number one, is we're not going to talk about it very much in this class at all, but it is a very short-term kind of investment. Most options have a lifespan of less than 90 days. So you're only going to have a strategy. You're only going to be protecting something for roughly 90 days. So it's not a very long-term risk reduction kind of a strategy. Here's an idea or the concept of dollar cost averaging. Again, here are the prices. This is a stock that has low volatility, and this is a high volatility stock. And again, essentially what we're going to do, as the price changes, we're going to buy the same amount of the stock. Over here the price changes, but it changes much more volatilely. So in the end, if you look at how many shares were purchased, right, we spent the same amount of money, but I only have 1,484 shares. Over here, I have 1,587 shares. So at $10, right, the total number of shares, multiply that by 10. If the stock doesn't have a lot of risk, I would have $14,840. And over here, I would have $15,870. What that does, I mean, obviously shows that the more risky it is, the higher the number of shares that you would own. But the purpose of dollar cost averaging is to smooth that out and ultimately to give me a lower average cost per share. In this case, the profit per share on average is $8.09, and on the other side here it's $7.56. So dollar cost averaging allows us to take a little bit of the guessing out. You always invest the same amount regardless of price. But the second thing that it helps us do is it helps us to lower the costs, which if you're lowering the costs, that also implies that you're increasing the profits. What about mutual funds? We're going to spend a whole chapter talking about mutual funds, so we don't want to get into a lot of detail there, but we're going to ultimately spend some time talking about how this ultimately works in the real world. And what I'm going to do is I'm going to stop here, and we'll continue this discussion in part 2.